Now that we have an idea about what fringe benefits are and how they fit into a payroll context, it's time to look at the specific rules for valuing fringe benefits. So, how exactly do we determine the value of fringe benefits? There's the General Valuation Rule, or GVR, which is the most common way to determine the value of fringe benefits. Basically, you're using the fair market value. For the personal use of company vehicles, though, three primary methods exist for determining the taxable income for employees. One, the lease value rule, two, the commuting rule, and three, the cents per mile rule. So let's start with the lease value rule. This rule is used when the employee uses the vehicle for work, commuting, and other personal use. An IRS publication 15B provides an annual lease amount for vehicles. So for instance, if the fair market value of the automobile on the first date is available to the employee is $28,500, the annual lease value is $7,750. This annual amount is multiplied by the percentage of the employee's personal use of the automobile, days available divided by 365 days times personal use, to determine the amount of the employee's taxable income. If the employer also provides fuel, it must be included in taxable income at 5.5 cents per mile of personal use. So to practice this lease value rule, let's look at the next example. Quinn is an employee of Caribbean Imports. His company car is a 2021 Toyota Prius LXE with a fair market value of $30,000 and a lease value of $8,250 according to publication 15B. During the year, Quinn drove 36,953 miles, of which 6,822 were for personal use. The car was available for use on 250 of the days during the year. All gasoline was provided by the employer and is charged back to Quinn at 5.5 cents per mile. What is the amount of the company car fringe benefit that will appear on Quinn's W-2 using the lease value rule? So we start with the annual lease value of $8,250 that is provided in this example. And this amount is an annual amount, which means that the employer would be taxed on the entire amount if the employee used the car the entire year and only drove the car for personal reasons such as commuting to work. In our example, though, the car was only available on 250 days of the year, and Quinn drove 36,953 miles, of which only 6,822 were for personal use. So our first step is to prorate the annual lease amount for 250 days. We do that by dividing the 250 days by 365 days, and it tells us that the car was only available for 68.4932% of the year. Then we find out the personal use percentage by dividing the personal miles of 6,822 by the total miles of 36,953, and the result is 18.4613%. We now multiply the lease value of $8,250 by 68.4932%, then multiply it by the personal use percentage of 18.4613% and arrive at 1,049.13. We also add the cost of the fuel that Quinn's employer paid for by multiplying the personal miles by 5.5 cents per mile. The value of the fuel is $375.21, and combined with the personal lease value of the car, Quinn will have an additional taxable income on his Form W-2 of $1,418.40. Let's look at the commuting rule next. You use this rule when the employee uses the car for work and commuting only. The commuting miles constitute personal use of the vehicle and is taxable at $1.50 per mile. In this example, the employee drives daily commuting miles of 10 miles each way. The employee works 5 days a week for 48 weeks a year, 52 weeks less 4 weeks vacation, less 9 holidays. So we'd calculate the taxable income by calculating first the number of commuting days a year. 48 weeks times 5 days is 240 days, less 9 holidays is 231 days. 239 days times round trip miles of 20 miles equals 4,620 miles at $1.50 per mile equals $6,930 in taxable income. Another method to value personal use of the company car is the cents per mile method. However, you can't use the cents per mile rule for an automobile, including a truck or van, if its value when you first make it available to any employee for personal use in calendar year 2024 was more than $62,000. In 2023, this limit was $60,800, and in 2022, it was $56,100. Under this method, you would calculate the miles for personal use and multiply it by the cents per mile rate. And there are 2 additional requirements, the regular use in trade or business and the mileage test. But you can find out more details in the IRS publication 15B. The standard mileage rate is 58.5 cents as of January 1st, 2022, 62.5 cents as of July 1st, 2022, 65.5 cents in 2023, and 67 cents in 2024. Another method for valuing personal use of a company vehicle is the unsafe condition method. This rule applies if a company vehicle is provided to an employee only because of unsafe conditions. The foundation of this rule is that the employee would walk, bike, or use public transportation under normal conditions. In these cases, the IRS specifies that the taxable income is determined by adding $1.50 for a one-way commute. However, there are additional requirements, such as that the employee must be an hourly worker and is not paid more than $150,000 in 2023 or $135,000 in 2022. In this case, you determine the taxable income by multiplying the one-way commute miles by $1.50. One additional transportation-related benefit to know about is that employers may exclude up to $280 in 2022, $300 in 2023, and $315 in 2024 from the employee's wages if the employer pays for the employee's transit pass.